Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to rip through Twitter, see what people are sharing, see what information there is. Some of it I agree with that I share, some of it I disagree with that I share, and I think are good talking points. So I'm going to give you my financial opinions as we go through it. It's going to be commodity, finance, wealth building related topics, and we're going to jump right into it. So if you want to follow me, it's at Buying_Finance on Twitter. And if you want to join, we still have that happy birthday coupon code up to 50% off the first month for finding-value.com. And we also have a question and answer session that is running right now. And you can ask me questions directly through Zoom meeting if you would like to attend through the website. Logan, I like Logan. I think he's got his head screwed on straight. Nick, on the other hand, Reventure Consulting, he is the bear of the century of everything. It says, for the sake of humanity, please get this guy to debate me live on camera. He can bring his entire doomsday clan with him, too. So this is Nick. He says, which means there will inevitably be lots of foreclosures in this housing cycle. All it will take is some economic turbulence for the unemployment rate to rise meaningfully. The mortgage defaults will jump as they always do. Well, I hate to say it, but in the 1970s, when that cycle was going up, unemployment went up with it in the 1970s in that inflationary period. Housing follows supply and demand, flat out. It's not unemployment. Unemployment goes up and down your depending on the market conditions. And we could see a gigantic shift in the market where unemployment goes up, but that may not always translate into foreclosures in homes. If I got laid off, I would not foreclose on my house because I'm not running that lean. A lot of the people who bought homes over the past few years have very high credit scores. People like myself, granted, it wasn't the past few years, and I know a lot of people who purchased homes personally. We're not running budgets that are real lean. We've got a lot of safety to hit through for us to foreclose on something that we're three, four, 500,000 equity positive. So we would have to roll through. I know probably at least 10 or 12 of my friends who all own homes. We're not paycheck to paycheck people, and I don't even know. I mean, I could probably lose my job and still pay off my house. It's like within a year I could pay it off easily. So there's a lot of things. I don't know if I totally agree with this data. And he tries to correlate these things and he has all these percents. I think he's just lost. I think he just doesn't know how to read data. That's my opinion. This Nick Reventure Consulting guy. But I can tell you this, his doom and his clips get a lot of views. He makes a lot of money from this, so he's obviously motivated to sell or push some sort of side of it. Uh, SRS Rock Report says Newmont's gold mines that weren't impacted by a decline in production still had massive AISC, so that's cost increases. The world has no idea how the falling energy return on investment and the energy cliff will impact the gold mining industry and the gold price. Got gold. And that's why I take a dual approach. Um, Gold mining and the mining industry is a play on it's a play on margins. Now, the price of everything, the commodity, is a play on basically the stupidity of humanity. It's and I like how these can basically complement each other. Stupidity of humanity means underinvestment in electrical grids in South Africa, the taxation of mines, the inability to open new mines, the not in my backyard mentality, the greediness of some of the corporations and how they may mess up the safety of a mine, et cetera, et cetera, et cetera. There's so many risks associated with building a mine, maintaining a mine, getting it running, and it could be all outside of the control of the company, the mining company itself. So I play both the commodity price because all of those risks push the commodity price higher. Everything I talk about pushes commodity prices higher. So the easiest way to play it is, well, just buy the commodity. It's it's that easy. Gold mining, it could very well be one massive leverage play, and I think that will be the case, especially in the beginning of a bull market. I think in the beginning, I don't think energy is going to be the problem in the beginning. I think we're going to see shortages in particular commodities, and then there's going to be a large incentive to mine. And that incentive is going to be your margin expansion for existing mines. Now, the problem is the incentive will come and you're going to get a large margin where the price of the commodity could go way up faster than their input costs. Margins expand, and then all that is more energy demand. So all these shortages in commodities is essentially increased future energy demand. And all of it's going to stop at the energy spot. So when he says the falling energy return on investment and the energy cliff, it's all interconnected. So the way that I would see, or the way my viewpoint is a lot of the money is going to transfer to a lot of the energy companies, either those that own the rights to the commodity, the oil itself, or the energy service companies themselves. But I do think there's going to be one big boom in the mining industry as well. So I do think there is going to be one. It says in China reopening, oil demand is showing up in Jody data. So Chinese demand increased by 1.71 million barrels per day to 17.37 million barrels per day, the second highest level recorded in Jody. And there it is up here in yellow, guys, 2023. That is ridiculous how much this is increasing. Demand for oil is very high, and I think it's going to continue to go higher. Wealth is directly related to oil consumption. And that's GDP wealth, is what I'm talking about, not just wealthier people consuming more oil. It is wealth is oil consumption, GDP growth. It says by law, the US Mint shall meet public demand for American Silver Eagle 1 ounce coins. However, since the silver squeeze, the Mint has severely restricted production and is now 270 million ounces behind demand. Significant. That's the entirety of all COMEX vaults that we are behind. So this is a 10% per year growth. You can see the market demand in the yellow here. That's the market demand based on excess premiums. This is your ounces of millions of ounces. This is your time frame. Your supply deficit is the difference between these two, total supply and market demand. And this is the deficit underneath it. So supply deficit's 270 million ounces. There's your gap between the two. And that is one heck of a gap. And you know what? The silver probably doesn't exist. That's the problem. So your premiums go way up. And the physical price is a function of spot price and premium price. And your premiums remain different. I just called my dealer and asked what are some of the premium differences if I wanted to swap. And I'm not going to swap. I just wanted to see what the prices were. The 100 ounce bar, which is in the least demand, is spot price. The 1 ounce, 5 ounce, 10 ounce rounds and bars are $1 over spot. So that's what the premiums are if you were to hand it into them. That's what the premiums are. At least that's what they told me a couple days ago. Or Friday it was. No, it was a couple days ago. Brazil, slight change of trend lines. Still, the Brazil ETFs look very, very explosive here. He took the top trend line and then he put another trend line on top of it. I usually draw this a little bit differently, but yeah, it looks really good. We've got crude oil. Singapore gas oil crack spreads explode higher, now back above $20 a barrel. The physical market is slowly improving. So what this is the front month crack swap. That is the difference between gasoline price and oil price. Think of it that way. And if you're getting a demand that's pulling gasoline from oil, what it does, it creates a tightness in the refining area, and that's where your crack spread goes up. So we're seeing crack spreads go up. You can obviously see here in the United States that the gasoline prices has gone up. So the crack spread, and the crack spread is it's the spread between oil and gas, and your refineries is where the money is going to be made there in your crack spread. New homes are getting smaller, so the national average unit size 2,700 square feet down to I don't know 24 something square feet. So I thought that was interesting. We got Bill Gross here. He says the bond bull market. There's some bull involved, but not for bonds. Bondholders will experience a continuing bear market with negative implications for stocks as well. Yeah, that's what I say as well. Read all about it in my latest investment outlook. So what he's thinking is higher interest rates. And when interest rates go up, that means bonds are being sold. It also has a negative implication on stocks when interest rates go up. Bill Gross, who's considered the bond king, is in agreement with myself, or I'm in agreement with him, however you want to say it. Interest rates are going to remain highly elevated. Who's read The Reminiscences of a Stock Operator? If you haven't, this is a required reading. The game of speculation is the most uniformly fascinating game in the world. But it's not a game for the stupid, the mentally lazy, the person of inferior emotional balance, or the get rich quick adventurer. They will die poor. Jesse Livermore. Gold to oil price still incredibly cheap. Says oil is actually, in a historical point of view, heavily undervalued compared to gold. The mean in this ratio is roughly 15. We're at 25.5. After such a big blow off to the upside, we usually see a full pendulum swing to the other side. We've gone all the way to a low of 6.26 on the ratio. That was in 2008. We went to an extreme on the opposite end, which was a negative oil price. So I don't know what you'd put for a ratio on that. And I think we're going to go to an extreme on the bottom, probably even below 8. And that's going to be a very high oil price if gold is moving higher with it. It could be $300, $400, $500 an ounce or a barrel. B of A gone wild. So Bank of America gone wild buys 137,000 ounces of gold and 8.8 million ounces of silver on the July contract so far, plus more records set in July silver. So they're on a buying spree, guys. Bank of America. I know they're massively short contracts, so they're probably hedging their bets. Here's Nick again. Yeah. Is another mortgage crisis brewing? Homebuyer debt to income ratios are now approaching 40% in the beginning of 2023. That means homebuyers are now spending 40% of their gross income on mortgage and interest costs, same level as 2006. I'm wondering how they calculate this. Is he taking like the average debt to average income ratio? Because if he is, we're so short on the housing market that this statistic is probably not a good statistic. You're not having average income people buy these homes. You're having top 10% income people buying these homes. So your debt to income ratio is actually not 40%. It's your debt to income of the people who are affording it and buying those homes. So this may be completely garbage data because you can't take the most tight area ever in the market and then take the average income because the average person's being priced out right now. So I don't think you can do what he is doing. Obviously, it's data and it shows what the debt is in relationship to the average income. But I don't know if this actually is the actual income of the people who are buying the homes. I don't think this is the debt to income ratio. I mean, if I went out and I bought a house, it wouldn't be 40% of my income. It wouldn't even be close to that. It wouldn't even be on this chart. It'd be like 5% of my income or 4 or 10% of my income or something. It says there are clearly not enough people paying attention to this. Brazilian equities are on the brink of breaking out from a 15-year resistance. Historically undervalued stocks with technical momentum and strong macro tailwinds as a resource-rich economy. Opportunities like these are rare, and when they arise, they are often overshadowed by skepticism. Brazilian stocks were breaking out to the upside almost. We're right there ready to break. And I agree, this is a huge opportunity. And there's huge opportunities across the board. So there's some incredibly cheap in sectors for investment right now. Bond King Bill Gross says bond bull market isn't in the cards as yields peak. Deficit, Fed quantitative tightening put floor under yields. 10-year rates to top 3.5% for a long, long time, he says. That's your inflation in the system. That is your real estate market, I think, adding fuel to the fire, inflation. So you're going to see higher for longer on interest rates. Javier says, chart of the day, global fertilizer prices have collapsed over the last few months, easing pressure on farmers. The chart is an index of the U.S. ammonia, phosphate, and potash price on a year-over-year basis. And if you look, we've come all the way back down, and we're basically back to support. I actually think that fertilizer, granted it'll probably base a little bit, it's probably a good spot to be looking for fertilizer companies. And you can see that we came up, we based out, we've broken out, we're doing a retest move right now. We're probably going to retest somewhere in this general vicinity where we're at, maybe 400. And then it's off to the races again. Patience. Charlie, the median price of an existing home sold in the U.S. is up 14% from the January low, now less than 1% below its all-time high from June of 2022. There we are, back to almost all-time highs with the price of homes. And you can see this cycles back and forth. So I'm curious to see what this cycle looks like up here, and if we go higher based off of maybe interest rates falling. I don't know. We'll have to see. But that's where I'm going to end it, guys. That's what I've got for today. Give me a thumb up for the content. Give me subscribe to the channel, subscribe to the website if you'd like. And that's what we've got for today, guys. So again, we've got a platinum question and answer session, 7 a.m. And it's going on right now. So that's all I've got. We'll catch you next time. This is Finding Value.